Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Chicago wheat and corn. I'll start with Chicago wheat. The reverse head and shoulders pattern and ascending triangle from earlier this year helped construct the latest patterns that are currently influencing the market. They help construct two new patterns, both of which have been triggered, one at the start of June and one last week. You see, the combination of the ascending triangle and the reverse head and shoulders bottom created the first larger pattern, an early March to early June sideways triangle. Now, I'm the first to say this is not a good looking example of such a pattern, but I also say that it still has merit. What initially disguised the pattern to me was how the market exited the triangle through the lower trend line by just going sideways instead of a sharp move lower. Nevertheless, this is a legitimate pattern, and I've placed some targets for this pattern below. Target X was the primary target in the 953 area, and target X1 is the harder to reach secondary target in the 700 area. The second pattern is obviously a related one in adjacency, if not in style. It is to take the formation between the head and second shoulder of the earlier reverse head and shoulders pattern in April, with the subsequent top side targets making the head in May. And to be honest, a limp-looking second shoulder formed in June, well, to make a regular head and shoulders top pattern between April and June. The neckline is currently 1040 and was broken on Monday last week. The primary target X2 for this pattern was in the 922 area, and target X3, the harder to reach secondary target, is in the 800 area. As a consequence of the moves last week, and this, target X and target X2 have both been reached. The most significant moves this week have not been reaching target X2, though that is important. Instead, it was the approach and initial rejection from the slowly rising long moving average below. That's currently at 915. Plus yesterday's subsequent attack and close below it, and yesterday and today's, well, to be honest, pretty dynamic punching down through and closing below the significant congestion area between 872 and 909. Now, this area did not really show up during the move higher back in February, and I'm not wondering if it is that significant at all. I'm not seeing anything happen on the way down. You see, it does contain a 50% Fibonacci line for the May 19, March 2022 move at 891, and the 50% Fibonacci line of the December 2017 to March 22 move at 887, plus until recently the slowly rising long moving average. Anyway, we next have November 2020 low at 845, along with a 61.8% absolute Fibonacci line at 843. Well, if these two go, there's nothing really from stopping the market reaching target X3 that's below. Chicago corn. Last week I drew my first bearish Andrews pitchfork for, well, I don't know how long. This week, the market looks like it's trying to verify that pattern, as the middle time, currently 664, was late last week and into the beginning of this week, using it as overhead resistance, with support being provided by the combination of the 50% Fibonacci line September 21 to April 22 move at 661, plus the rising long moving average, currently 656. The market was getting squished between the descending middle time and the stationary 50% Fibonacci line until yesterday, when, like a tube of toothpaste that gets whacked, the market gave way on the downside, spurting, I don't know if that's a word, but pushing prices lower and punching down through the 50% Fibonacci line and the long moving average and dropping in a fairly free zone until it reached the August 2020 to date uptrend, currently at 630, where it closed yesterday. Today we've seen a fresh but limited exploration of the downside, down to the lesser Fibonacci congestion zone around 622. Now, in the process, prices have filled an old gap left over from February. As usual in any gap filling exercise on the downside, the market turned back up once it had done the filling. So what is next? Well, trust in the tines of the bearish Andrews pitchfork, the middle tine above and the lower tine, especially currently at 610. That's below. Additionally, though we don't have much below the lower tine marked from days past, you can clearly see support starting to kick in below from 600 even and dating from the turn of the year. Thank you for listening. This weekly broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.